All right, so what other questions can we help people with?
Hi, Tonya. Hi, hi, guys. This is Rajesh.
Hi, Rajesh. How are you?
I'm from EXP Commercial. I just joined it. My question is that how you evaluate businesses, what valuation method you use to evaluate the business. And I'm not, you can, like a business brokerage can sell the small businesses, but if you are involved in large businesses, do you require the FINRA license, like according to the Security Exchange 1934?
So securities licenses, there is a federal law that was signed in recently is that exempts business brokers from requiring or from having to have securities licenses when selling businesses, but they have to fit certain criteria. I think they have to have less than 25 million in profit and I don't know. I forget the actual requirements, but for the most part, no, we don't need securities licenses to sell a business. That being said, that's when you're selling a business in its entirety. So you cannot advertise or market that you're selling stock. You can't advertise or market that you can't do capital raises and things like that. So depending on what you're trying to do, you may need a securities license, but every transaction is different. So if you're selling, let's say you're selling a business for $40 million. If it's a private equity firm or somebody coming in that's buying that business, you don't necessarily need to have a securities license depending on how that deal is structured. However, again, when you're marketing the business, you have to market that the business is for sale. You can't market that you're selling 80% of the stock of the company, or, even if the owner wants to retain equity, a lot of private equity firms will do that. They'll want the sellers to roll equity into the new organization, but you can't market that in your marketing materials. You can't market 80% of a business for sale or something like that, because then you do get into the security issues, the security laws. So it really just depends on the transaction. And I think that, for every transaction, depending on how it's going to be structured, what the seller wants up front, you're better off to talk to a securities attorney and to have a business alliance with a securities attorney in your state if you think you're going to run into a problem there, and let them tell you whether or not that's a transaction you can take on or whether it's something that's going to need a securities license. And also, even though the law's passed at a federal level and was signed into law at the federal level, certain states have state laws that require securities licenses to transact businesses as a stock sale, as opposed to a purchase, an asset purchase, using a stock purchase agreement as opposed to an asset purchase agreement. So again, it's knowing your state laws or connecting with a securities attorney in your state who can advise you, because ultimately you want to make sure that you're operating within the bounds, that you don't cross the line of what you can and can't do in your state. Where are you located, Rajesh?
I'm in Memphis.
You're in Tennessee?
Memphis, Tennessee, yeah.
Okay. Yeah, I don't know anything about Tennessee state law, to be honest with you.
So another my question is there are valuation tools are available. So what you guys use for valuation of the businesses? What tools you guys are using?
So I have a lot of spreadsheets and things that I've set up over the years that I use for valuations. I've tried several different valuation tools it depends. I mean, I can tell you, what is the purpose? Am I trying to determine an asking price, or am I trying to provide a valuation report? So I use different things depending on what I'm doing. If I'm trying to determine an asking price, then I've got some spreadsheets and things that I use. I'm going to do some market research. I'm going to obviously get their last 3 years of tax returns, P&Ls, balance sheets, run the financial analysis on that. Going to look in biz by sell, maybe at their sold comps, and also at biz comps and deal stats, and look for some comparable deals, although those databases are pretty sparse depending on the kind of business that you're using or that you're selling. Don't always have a lot of information that's truly comparable. So I would say that business valuation, it's an art and a science. Crunching the numbers is a science part, but there's other factors that go into it. The owner centricity of the business, like Doug was talking about. If the business is too owner centric, it may have a lower value if it's saleable at all. You could have, in smaller businesses, sometimes you have HR issues where they've misclassified their employees, and they're paying them as they've got them classified as independent contractors. So therefore they're not paying payroll taxes, and they're not paying workers' comp on them in some cases. So there are other issues that affect value that sometimes you have to dig a little deeper to try and identify. And for that reason, I just find that some of the tools that are out there are not as helpful as I'd like them to be.
And Tanya, maybe to add to that just a little bit for Rajesh, I mean, when I look at the valuation end of it, I tend to most of the time be fairly simplistic. I do have a little template that I'll use if people just need an opinion of value, and I will charge for that. But typically, we'll access an industry specific rules of thumb. Like for instance, the Business Brokerage Press puts out a great pricing guide that comes with your IBBA membership, called the Business Reference Guide. And then, that's kind of your quantitative, that those are usually based on a multiple of earnings, or sometimes in some industries, they use more of a percentage of revenue based model. But that kind of gets you a range. And then you have to look at the qualitative factors, like Tanya was saying, what are those things that make the business more desirable, where there's more demand and that pushes it up the range, versus those things that are less desirable that pushes it down the range. And that's kind of a more simplified approach sometimes to look at it.
Yeah, and if I could also speak to that too, like structure comes into play. So, and as Jared was talking about range, so you have businesses that might be unsellable. So you have everything as a multiple seller discretionary earnings or recast EBITDA or whatever it's called in your world. But in smaller businesses, yeah, the range is relatively tight. And it might be 2.8 to 3.2. When you start getting into larger businesses and in attractive segments like 3D manufacturing or advanced manufacturing or something like that, where you might be able to get multiples of 7, 8 times. So that's a big range. I mean, when you talk about 0 multiple maybe, or 1 or 2 or 3 up to 8. And so there is the two parts to the equation. And then there's a third part, which is structure. And so, like, for example, let's say you're selling a company and the seller is willing to hold a large amount of the note at a sub market rate for interest. Well, that's valuable. Let's say, market interest right now might be 7%, 6.5, whatever it might be. And he says, okay, yeah, I'll pay asking, and I'll hold the note for 50% at 4%. Well, you're getting a premium on the market. So structure will come into play, as far as value as well. And also, what will the owner do as far as staying on? I would say this, and I'll caution, like anybody that thinks that it's a great deal for the owner to stay on, CEOs of sold companies, they historically don't last more than 12 months. I mean, it's like 80% of them don't last 12 months, even though it might have been their intention to stay on for 5 years and get a second bite of the apple. It's just because, particularly private equity, when they buy a company, they want you to work. They're not buying the company for what you did last year. They're buying the company for 20% growth year over year for the next 5 years. And they're going to want you to work your tail off. And CEOs that maybe, founder CEOs that have been running their company for 10 years, and then find out, hey, I've been working 50 hours a week. They want me to work 100, or they're not going to pay the full payout or something like that. It leads to problems. So I really try and discourage CEOs. That's why I'd rather build the infrastructure up front. I'd rather build the supporting management team up front, and so that the CEO or founder owner doesn't have to stay. And if he stays, it's maybe a 60 to 90 day deal. But that does also add value, whether or not you're going to pay him for those 90 days. So I would just caution you not to look too much as the multiple, because the devil's in the details. That's what we do, is we negotiate those finer points. And I'll say one last thing is working capital. When you get into deals that are probably over $1 million, working capital is going to be one of the biggest hurdles you're going to have. And basically the way it works is a buyer comes in, and let's say you're offering a company $5 million, and their weekly payroll might be $200,000, or I'm sorry, monthly payroll like $200,000, and the seller is taking accounts receivable. So all the receivables are going to the seller, all the cash goes with the seller. The buyer comes in and says, wait a minute, I'm not going to be able to sell, I'm not going to have any money coming in the door until I start selling product, and you're on 30-day terms. So I'm not going to have any money for 30 days. So they literally have to put working capital into the company above and beyond what they're paying for the company. So that is probably one of the biggest deal, I'll say, breakers that happens, because the seller has the opinion that all accounts receivable are his. And the buyer says, well, I'm paying you $5 million. I'm paying what you asked, but you're saying I have to put another $500,000 so I can make it the next 30 days. And so those are all things that go into value and change value. So it becomes a little bit more complicated as you get into larger transactions.
Yeah. And I think a lot of what you're talking about, Doug, it sounds like you do a lot of lower middle market.
Yeah.
And middle market deals, which is great. And there are definitely some differences there. IBBA in general is focused on I shouldn't say IBBA as an organization is focused on Main Street and supporting Main Street business brokers. And I think that M&A Source is focused on lower middle market. I think when you're brand new in business brokerage, you're probably going to be doing more Main Street initially until you get yourself skilled, because you need to learn what you're doing. And the last thing you want to do is, get a $10 or $12 million deal and then screw it up because you don't know what you're doing.
Yeah, that's what I'm saying. You call me.
Yeah.
I'll do it with you.
So definitely, and a lot of what you're saying, Doug, is absolutely correct. And that's all part of what we do as business brokers and as advisors, is we have to educate our business owners, because the business owners don't know that. They don't know that their expectation is, hey, I've got $300,000 in receivables, that's going to be mine. And we have to educate them and let them know that, hey, before we ever bring a buyer to a table, we've got to explain to them that the value, because of the size of their business, the value is going to include average working capital or necessary working capital for a business operations. And so then we have to have the conversation with them about what are your working capital needs? What is your operating assets less your operating liabilities? What does that number come down to? And help them identify what that is. So yeah, the valuation is key. It's a critical component. I was looking at something for one of my mentees earlier this morning. I don't know, he had somebody else that had, before he became a mentee, that had given him some inaccurate information, but essentially he's got kind of a retail place doing under $500,000 in gross annual revenue that's been priced at $700,000. Well, that is never going to sell. It's just not. So I basically sent him an email and said, okay, we need to start over. So let's get all the tax, we've got the tax returns, but let's start over. Let's do a proper valuation. Let's determine a proper asking price. And then let's get a Zoom conference on board with the seller, and let's go educate the seller and explain to him. The problem with a lot of people who are either commercial agents or residential agents, but are not business brokers, is when somebody asks them, one of their clients says, hey, can you sell my business for me? And the response is, okay, well, how much do you want for it? And quite honestly, what the seller wants for a business is not relevant at all. Okay. The only time, it does factor in, knowing what their expectations are is actually a good thing sometimes. And I'll, after interviewing a prospective seller, asking them about the business and what the gross annual revenue was and a few other things in my pre-qualifying process, I might say, well, do you have an idea of what you want for it? Or do you have an idea of what it makes it worthwhile for you to sell it? Do you have a number, a target number in mind? Because I want to know what that is, because if their target number is $5 million and they've told me that their gross annual revenue is $1.2 million, unless they have some intellectual property, some patents on something or something that's going to create that increased value, that's just, you're dealing with the Grand Canyon there. You can't build a bridge that far to make it worthwhile. Not, they're going to need an exit planning process, strategies. They're going to need to grow their company to hit that target market. Or that target number that they're looking for. So it's all about educating the business owner and setting their expectations to be realistic.
So guys, do you have any of you, like any e-commerce company that you are having in your listing, or what is your specialization? What kind of business you are listing?
Well, I tend to work with, I like manufacturing and I like professional service firms. I sell pretty much everything. But because, if somebody refers me something that's not in my target market, referral sources are priceless. So you don't burn referral sources just because it's not necessarily what you enjoy selling, right? I enjoy selling manufacturing. I enjoy professional service firms. Both of those are very broad categories. So manufacturing could be food manufacturing, could be aerospace parts, could be a job shop manufacturing services. It could be, garment manufacturing, plastics. There's so much that falls under manufacturing. And then the same thing with professional services. You have dentists, doctors, lawyers, tax practices, accounting practices, property management firms. So both of those are very, very broad categories, which keeps things interesting. But that's just what I like. Jared, what do you like?
Yeah, so I've on the mainstream stuff, I've done really well with service businesses. Like you said, it's a broad category. In a lot of service businesses, what you do is kind of transferable to a different type of business. I used to own restaurants, so I've done a lot of restaurant work as well, and with franchises. But as we move up into the lower middle market space, I've actually found a great niche in the trucking industry. So anything trucking nationally, I'm in a lot of those conversations, and I've got 3 trucking deals going on right now. So that's a space I really like. It's a really fragmented industry, and there's always acquisitions going on. It's tricky. You need to have some specific knowledge, but if you have that knowledge, you can be a real go-to person for those guys. And there's a lot of other industries like that. I know a lot of people are in manufacturing, and I've done a couple of them, but I don't really focus on manufacturing because that's one of the most competitive spaces for business brokers. I like to find the other niches that are a little bit, less worked. And I think it's a little bit easier sometimes to get clientele for that. Yeah.
And Doug, I know you said you like manufacturing, and is that your primary focus, or what else? What other areas do you focus on?
I do a lot in manufacturing, and same reason you do. I like it. I enjoy the owners. They're good, down to earth folks, and a lot of them are. And in the state of Florida, though, there's also a lot of money. The state is really putting a lot of resources behind onshoring and manufacturing. So in the state of Florida, we have 13 what's called RMAs, Regional Manufacturing Associations. And I belong to 2 of them. And I'm also on the board for the Association of Supply Chain Managers. So there's a lot of resources to work with manufacturers. and they're very sellable. You know, they're just typically, as long as it's in a good field and they have a good product. The challenge, I guess, with manufacturing for me is if it's like a job shop,
Mhm.
and they're just you know, they're only just taking orders and making product to order, it becomes a little bit more difficult because buyers, if they're going to pay a higher multiple, want to see a consistent revenue stream, you know, contracts with suppliers and things like that.
Yeah.
But no, yeah, I do that. I do restaurant. I've been in the restaurant business most of my life, and I used to own. I was with Outback when they started. I started my own company. So, I mean, in Florida, most people know, you know, in the restaurant business, kind of I've crossed their path one way or another. So
Mhm.
I tend to get a lot of restaurants. I tend to turn away a lot because particularly if there's not really good real estate attached to it, it's difficult to sell. Or if unless it's a really good location, maybe, and it could be a lease if it's a good location and a good brand name. But and I represent a family that has 50 Burger Kings. I represent some on the commercial real estate side. I represent a couple brands like Zaxby's and a couple others. But
Okay.
I turn away a fair amount of restaurants just
Yeah.
because they're too
Well, you
hard.
should refer them out. I mean, I'm sure you do.
Oh no,
refer
I have
'em out,
18
so-
people on our team that I
Yeah.
refer them to. Yeah.
Okay.